Investors globally have witnessed a bout of volatility since the start of 2022. Russia's invasion of Ukraine fueled a sharp rise in global commodity prices. Also, rising expectations of aggressive tightening by the US Fed and other central banks to tame surging inflation and restrictions in China following a recent rise in COVID-19 cases led to a fear of slowing global economic growth. As a result, global equities fell by 15% since its recent peak. European stocks are significantly impacted by war in Ukraine, with both sentiment and supply-side challenges evident. The decision to reduce and quickly eliminate the reliance on Russian oil and gas poses an inflationary and logistical challenge. Inflation concerns are becoming more of an issue here. US big tech stocks, which have dominated market performance for the past decade, have been at the epicenter of the market sell-off as a double whammy of rising borrowing cost and the prospect of slower growth impacted assets whose cash flows are far out in the future. Emerging markets underperform the world index that is skewed by heavy losses in China and more recently Russia. On a one-year basis, the emerging markets delivered negative 18% versus global equities, which are down just 2%. China delivered negative 36% for the same period as Chinese tech giants saw a major correction of roughly around 50% that was triggered by regulatory crackdowns. The correction in emerging markets has led to a widening valuation gap between India and EM, making EM and China in particular relatively more attractive from a valuation perspective. For US equities, we see two offsetting developments. On one hand, the strength of the recovery is leading to fundamental improvements, with corporate profits continuing to rise in most sectors. On the other hand, we must recognize that much of the recent rally was sentimental optimism, with valuation stretching, creating potential vulnerabilities amid higher interest rates. Taken together, at current prices, US equities still look expensive overall according to our analysis, both in absolute terms and relative to international markets. However, this view has moderated following the year-to-date market correction as valuations have improved. Apart from this, Europe and UK equities also offer attractive investment opportunities.